Hello there, welcome to this edition of Global Business Africa. It's the 23rd of July 2014. We have a comprehensive lineup of all the business stories making headlines across the entire African continent, across all the four corners, quite literally, Cairo to Johannesburg, and of course Nairobi, all the way to Lagos in West Africa. We've got an interesting lineup for you. Here's what's coming up. Somalia's president has dismissed a report accusing him of diverting Somalia's assets. Nigeria's central bank governor chooses to remain on the exact same course as his predecessor. We'll be live in London. And learning from your students, we'll be looking at a former Zambian teacher who's a thriving entrepreneur based on lessons from his students. Let's start in Somalia, where President Hassan Sheikh Mahmoud has dismissed a UN monitoring group report that essentially accused him, alongside the foreign minister and a US-based law firm, Shulman Rogers, of diverting Somalia's assets abroad. While addressing the federal parliament, President Mahmoud said that his government had responded to the allegations. Now, it's important to point out that the report has not been fully unveiled, but if the allegations in it are proven to be factual, they could lead to sanctions on Somalia if they are adopted by the UN Security Council. Somalia, of course, is engaged in efforts to recover its assets abroad. It has even sought advice from the World Bank's Stolen Assets Recovery Initiative. The latest development is likely to frustrate these efforts, as well as plans to attract FDI and donor funding as the government focuses on the country's reconstruction. The former Foreign Minister Fawzia Yusuf has also denied the allegations.
The UN monitoring group has another report that has accusations and concerns. The government of Somalia has responded. We forwarded our response to the UN. I want to tell the federal parliament that both the issue of public finances and arms control are taken seriously by the government, and we've actually made progress on the same. I, however, want to say we are not happy with the report and the approach used.
It wouldn't be a stretch to argue that the world quite literally runs on oil, and Africa's oil and gas sector is right on the verge of a boom. That, at least, is according to a PricewaterhouseCoopers report released on Wednesday. It says that the continent has enough reserves to last the better part of the next 100 years. Here's Angela Kopler with more.
Last year, 6 of the top 10 oil discoveries happened on the African continent. And when it comes to natural gas, we have 70 years of production on hand. It appears then that opportunities are everywhere.
There's a lot of interest in the industry in Africa. There's a boom happening in East Africa from natural gas point of view, in Mozambique and Tanzania, and in other parts of the continent as well. And even if you take it back to South Africa, a lot of interest in the upstream exploration and production industry in South Africa, both onshore and offshore.
Local skills development is becoming a key focus area, with some countries enforcing strict regulations to ensure that talent is developed and employed.
So I think there is certainly in some countries an investor appetite that's waning, but in some areas it's still not having an effect, and certainly international oil companies are wanting to get more locals involved with their local operations within communities.
There are challenges, however, and they differ from country to country.
Infrastructure is clearly one of them, because a lot of these developments are taking place in countries and areas where there is no infrastructure, so it needs to be done and built from scratch. And the second one is around the regulatory challenge and uncertainty. Investors want to know that if they make an investment, what is the return going to be? How is the government going to treat them? And they therefore want regulatory certainty.
Last year, the African oil and gas sector saw transactions valued at $1 billion happening every 17 days. And this is despite an uncertain fiscal and regulatory policy environment. Imagine the opportunities and possibilities if there was more clarity. I'm Angelo Coppola for CCTV in Johannesburg.
Let's stay in South Africa. The country's biggest union will continue with its strike, which started on the 1st of July, until the latest wage offer has been deliberated and agreed upon, or not, by its workers. Spokesperson of the National Union of Metal Workers of South Africa, Castro Ngobese, said in a statement that the last word depended on members on the shop floor who would consider the offer over the next 2 days. The union took the latest pay offer, which was a 10% rise for some categories, to its members for approval on Wednesday. This, of course, is part of a fresh effort to end a 3-week strike that has cut output at several car factories, including GM. More than 200,000 metal and engineering workers stopped work on the 2nd of July, demanding higher wages. The Steel and Engineering Industries Federation of South Africa on Tuesday reluctantly, quote-unquote, agreed to raise salaries by 10% and gave unions until Friday to make up their minds. Nigeria's new central bank governor says he favors a gradual reduction in interest rates over the next 5 years. But inflation risk does mean there's no room to ease policy rates immediately. The governor, Godwin Emefiele, made those comments at his first Monetary Policy Committee meeting since he was sworn in as Lamido Sanusi's successor last month. He flagged underlying inflationary pressure as one reason to be cautious and to keep the policy rate at 12%. That's the level it has been at for the last 12 years. Consumer inflation in Africa's biggest economy went up for the 4th straight month in June to hit 8.2%. That's a 10-month high, well within the bank's current target of between 6 and 9%, but trending higher due to higher food prices. Emefiele essentially has stayed the course of his predecessor, Lamido Sanusi, in keeping monetary policy fairly tight. Let's get you some feedback now, not exactly the analysis and the feedback on monetary policy moves in Nigeria is like. Miriam Bema joins us now from London. Miriam, the decision here essentially to hold rates, has it banished any concerns of looser monetary policy following the departure of Lamido Sanusi?
Well, it has, but it's more a question of there's mixed views on it on this end. Experts are worried that balancing or trying to balance government spending and actually boosting growth will be a difficult challenge if we don't see some sort of easing measures, but that also comes at a cost. The economy is only expected to grow by at least 6.2% this year, and many are watching actually to see, Rama, if the central bank takes that first step in cutting rates, perhaps even a small gradual step later this year before the election. The bigger concern is national debt, especially with the upcoming election, of course, and government spending is projected to rise ahead of those polls, and that's expected to keep pressure on the currency and price growth, and the central bank will not want to exacerbate that by loosening policies too aggressively.
Indeed, but the fact of the matter is, Mariam, that the governor here is in a damned if you do, damned if you don't situation. So how do economists and analysts view his argument that he wants to gradually cut rates over the next 5 years if the conditions are right?
Well, what's interesting is talking to a lot of analysts on this end, there's a level of trust in the governor and the new governor, especially with his background as the former managing director of Zenith Bank. But the borrowing costs, of course, as you had just said, have stuck to 12% for the last few years, 12 years that is. Investors are viewing his comments to try to mark a reversal of that sort of hawkish policies implemented by his predecessor, and whether or not the central bank can actually curb inflation as well. So it's sort of just, does he have the means to provide that credibility behind the confidence that investors have in him now? But what we are already seeing is that investors are parking their cash in government bonds and selling riskier assets. There's optimism that despite gradual easing, Nigeria already rebased its GDP in April, pushing it up to $500 billion US, enabling it to overtake, of course, South Africa to become one of the largest economies.
Indeed. Finally, Mariam, given election-related spending this year and for the better part of the first quarter of 2015 ahead of the elections, isn't it likely that rate cuts might be pushed much, much further back into 2015 if they do come in that year at all?
Absolutely. There's concern that Nigeria's new governor is being ambitious and sort of pursuing both the low interest rate environment and trying to ensure exchange rate stability and building up foreign exchange reserves. And experts say that we could see a scenario where if the central bank lowers interest rates, the naira and the lower inflation could be jeopardized. And experts say that the currency has depreciated rapidly this year because of the policy's uncertainties. So certainly the concern is that the government will have to portray a spotless image in the midst of all of these issues, of course, ahead of elections.
Indeed, we'll have to keep tabs on the monetary policy front and see how that develops. Thank you very much for that. That's Miriam Bema there live in London. Let's make a quick run through the equity markets here for you just before we jump into our first break in the show. The bit of a mixed bag here. The Nigerian and the South African markets ending the day in the red. The EGX and the NSE in Nairobi, however, ending the day in positive territory. Pension funds have been the holy grail of private equity funding, and now it seems someone's cracked it. We'll be looking at that shortly. And we'll also be looking at a mobile app that's making quite the difference for Ghanaian farmers. All that and more is coming up. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies.
From small businesses to large-scale enterprises, hear directly from entrepreneurs behind the story. It's about putting you in the picture so you know where Africa fits in the global context.
Global Business, weekdays at this time on CCTV Africa.
We do know that the strike isn't anywhere near close to coming to an end either. That means that those workers are going to sink even further into poverty.
Welcome back. Now, the volume of private equity deals across Africa has been rising, but it's only in 2014 that we're now seeing local institutional investors, especially if you remove South Africa out of the equation, finally taking the plunge into funding private equity. Ascent Capital, which operates in about 3 East African countries, has raised $50 million. About 10% of that came from pension funds in Kenya, East Africa's biggest economy. Now, in March, an annual survey of reported private equity activity indicated that over $3.5 billion had been raised by Africa-focused PE funds in 2013 alone. The South African Government Employees Pension Fund was active in private equity, but Africa Assets and Deloitte both note that in that survey that most of the cash came from development finance institutions. Clearly then, the holy grail of PE financing has been found. Let's find out exactly what this means for you. David Owino is a partner at Ascent Capital. Prior to that, he spent 12 years at Centum, a listed Kenyan investment firm, running its private equity division. He was overseeing a portfolio while there with about $150 million in assets. Thank you for your time this evening.
Thank you.
Does private equity in Africa have an image problem?
I don't think private equity in Africa has an image problem. What I think it is that it's a nascent industry in Africa. Mm-hmm. We started hearing more of the buzz of private equity over maybe the last 8 to 10 years. Mm-hmm. And so it's a new industry, it's a new asset class. Yeah. So, and it's building up, and it's my belief that what you're seeing in Kenya now or in East Africa, or what you're seeing more happening in West Africa and in Southern Africa is just something that's coming out of the woods. Mm-hmm. And the popularity of it as an asset class for both investors and also as a source of capital for entrepreneurs is becoming more and more visible than before.
Looking at what you've raised, about $5 million, give or take, from local Kenyan pension funds, what is the biggest obstacle that you faced in doing so? Because I know we had this discussion in March, and the whole host of issues, regulatory barriers, the institutional investors don't understand the asset class, they're very wary of putting the money into PE. What is the biggest one this time?
I think the biggest obstacle, because when raising this fund, this was my first time to go around and try and raise funds. It was more of lack of knowledge of the asset class. Many of the people who are actually the trustees who are given the responsibility of managing the assets on behalf of the pensioners or the contributing members do not understand the asset class. Mm-hmm. So that for me clearly was the biggest obstacle, more than the regulatory issue that may be there. And in my own opinion, I don't think that the regulator is an obstacle per se. Mm-hmm. It's just the nature of how the whole industry is governed. Mm-hmm. The trustees don't understand how it works. So,
but given the fact that the regulator has to approve investments in private equity on a case-by-case basis, I mean, surely that does slow you down a bit, doesn't it?
Exactly. It gives the trustees a bit of more fear that with other asset classes, they don't have to go to the regulator to get an approval. Though it's not an approval per se, it's actually a letter of no objection. What the regulator basically does is to see that if you are applying to move to that asset class, you have clearly put that as an objective or as a policy in your IPS, in your investment policy statement.
Yeah.
So most of the funds we have locally didn't have a provision for putting money in private equity as class. So you can't go straight ahead and do that against your own policy statement.
Yeah.
So I guess they were just acting as a governance step to do that. And that now creates a little bit of fear on the trustees because they trust their other asset managers to do all the other investments for them without necessarily going back to the regulator.
Yeah.
Then in this case, you have to go to the regulator. So the question you ask yourself is, why
do we have all our T's crossed and our I's dotted?
Exactly, exactly.
Right. You've been in private equity for the better part of a decade now.
Yes.
When it comes to raising capital from DFIs versus raising capital from institutional investors, what are the pros and cons of each fundraising approach?
There's two things. I don't think there are pros and cons on both, but that the DFIs, especially if you look at our market, which is sort of an emerging market or a last frontier, if you look at the objectives of a DFI, they fall under four sort of categories. Firstly, they look to create sustainable, develop the private sector in a sustainable way. Secondly, they look to catalyze development in these emerging economies or developing economies. Thirdly, they have to remain financially viable over the course of period of time. And then fourthly, they have to catalyze private capital to come in. Okay? So the DFIs have to go through all those four processes. Whereas if you went to a normal commercial investor, basically he'll be looking for an alpha, for a return. Okay, so long as you're not doing anything wrong with the money.
Part of they say, I don't particularly care how you do it, just give me my money.
So long as you're not doing any illegal business, you're doing legit business, I want you to give me a better return than any other manager could do. But for the DFI, they have to look at several things across them because they are owned by governments and their role is to catalyze development.
But isn't that, I mean, we've to quote a horror story I heard recently, in some instances, companies that have been asked, that do have money from DFIs, have essentially been told, look, you can't do business in this country, you can't do business in this asset class, you can't do this in this particular country. It seems like you're essentially getting into bed with a nanny state here when it comes to DFIs.
No, not necessarily, because before you get any money from the DFIs, they'll have given you the string of the conditions that you're taking the money on. And once you sign on the dotted line, it means you accepted all those terms and conditions. So down the line, you can say, look, I want to go to that place, and it clearly was not there in the first place. So it's money that's coming with strings attached. You understand the strings attached to them, and you can't go against them. You have to respect that relationship from what you had at the beginning. So if you're going to go for the DFI money, then it'll come with the strings attached, and you have to just...
You have to live with a nanny state.
It's not a nanny state, but you just have to go with them and respect the contract that you signed with them, because usually when you're going to get the money from them, you understand until they even ask you, do you understand our conditions? You're signing on these contracts, and you negotiate with them all those conditions. And once you agree on this, then you just have to follow. All right, we'll have to leave it there, unfortunately, but thank you very much for your time this evening. Thank you. That's David Owino, is a partner at Aston Capital, here live with me in studio. Let's move on to Ghana now. A mobile app in that country is helping farmers to increase crop yields and connect with industry players through a fairly seamless communication medium, which is easily accessible and cost-effective. In What's Hot Tonight, we focus on M-Farm. It's an internet-based platform that links all actors in the agricultural industry, giving farmers access to vital data.
In a farm in Tamale, northeastern Ghana, farmers are busy tending to a new crop of vegetables. But this ordinary farming community is learning to use technology to increase yields. Using a new mobile phone and internet platform called M-Farms, farmers access a wide range of information which connects them with a network of potential buyers and sellers. Bawaya Musa grows vegetables and grains on his own small holding. He is among those reaping benefits from the mobile application.
It improved the yields, and alternatively, our income level has risen, and we get food for our homes and the family. Then we get money, extra income from what we are going to dispose of. So we use that disposable food to pay our children's school fees and take care of the medical and other needs of the families.
M-Farms was introduced to Ghana by ImageAd, a local software development organization supported by the Alliance for a Green Revolution in Africa.
Now they are able to better plan and better know what they need and the costs involved. And also because we are connected with other stakeholders, we are able to give them best technology in terms of seeds, fertilizer, and this really helps them to be able to cultivate and within a small area get better yield, and their production systems also change, because we are be able to provide them new production systems through the information we get from M-Farms.
Farmers using M-Farms on their phones receive information about good agricultural practices, where to locate inputs such as seeds and fertilizer, and other support mechanisms. Farmer-based organizations, or FBOs, that work with the farming communities can also view maps showing the location of warehouses in the areas that have space available for storing crops ready for market.
We are looking forward to a day where we will not even have extension officers going to the field to take data. Rather, farmers themselves will be sending us those data. That is where we are looking at. Well, if the farmers are equipped to be able to send this data themselves, I think it will be even more valid than what our officers are doing. Well, they know the timing of these all activities. So I can say that M-Farms is going to play a major role in the operations.
M-Farms brings farmers and buyers together, specifically those interested in purchasing their maize, sorghum, cassava, and other produce. The Alliance for a Green Revolution in Africa was established through the support of Rockefeller Foundation and the Bill and Melinda Gates Foundation in 2006. The organization assists farmers access better quality seeds, markets, and affordable finance. AGRA also lobbies for policy change.
What AGRA is doing is to enable them through our farmer-based organization support center for Africa to put farmers together through the farmer organizations and support them, give them the power to negotiate for credit, to buy their inputs, and give them the power to negotiate for the sale of their produce.
The M-Farms platform is active in 17 African countries, including Kenya, Burkina Faso, Mozambique, Tanzania, Malawi, Sierra Leone, Nigeria, Rwanda, and now Ghana. Jane Keo, CCTV.
Right then, quick run through the commodity prices here for you. A fairly positive day in the markets here as far as crude, gold and cocoa are concerned. Coffee, of course, taking a bit of a hit. Uganda's supply, however, did drop. We'll get to the details on that online on Global Business Africa later on. But also keep in mind the fact that crude oil industry in Nigeria has still been in decline. It shrank by about 13% last year, according to data from RenCap. First quarter down by about 6.2 percentage points. The pace has slowed, but it's still a problem. And we'll be talking to a Zambian tourist lodge owner who has his students to thank for his newly found fortune. We come back on Global Business.
BizAsia. Asia means business.
Welcome back to the program. You're watching Global Business Africa from the Kenyan capital, Nairobi. Now then, let's talk about an engineer by training and a college lecturer by profession. His name is Dominic Molwisa, and he made the jump to being an entrepreneur like so many others do after he was pushed out of work. Inspired by those he's taught, however, he made a bold leap into the hotel business, and right now, he couldn't be happier. In tonight's Grassroots segment, he tells us what it took to open his business and what his greatest challenges have been.
Wherever I went, I found my former students who had opened their own companies and they were running their companies. Then I realized, well, if my students are running their business effectively and they're using my brains, which we shared, then why can't I make it? Then in 2009, there was what they called change of the boards in the institutions of higher learning. So I was one of those who was pruned. Then I thought, well, this is a chance. Now that I have nothing to do, I can start a business. And that's how we opened Chapa Classic Lodge.
Can you give us a landscape of tourism here in Zambia?
Some 20 years ago, the major employers were textile industries. Okay. Then upon the diminishing of textile industry, tourism came in. And most of the tourism industries were being run by foreign entrepreneurs who invested, or rather foreign investors who came to Zambia and were running the industry. But I would say about 10 years ago, the Zambians started coming in and we started joining the tourism industry. I went to Zimbabwe, went to South Africa, went to Namibia. I saw what was happening. Then when I came here, I discovered that I think we are lacking bed capacity in Livingston. So as a result, I thought I should start the accommodation business. 2001, that's when we established Chapa Classic Lodge with 3 rooms. From there, to date, we now have 27 rooms.
What were some of the challenges that you faced then and some of the challenges that maybe you face now?
Well, the major challenges to start business in Zambia, I think, is where you just deeply depend on your pocket first. Yeah, and then that becomes so difficult because most of our colleagues, the foreign investors, they borrow money in their countries, they invest here, and it becomes so easy, and they're given a rebate maybe of 5 years without paying tax. But as a Zambian, I start business today, I'll start paying tax. As a Zambian, you struggle for a long time before you even stand on your ground. But having said that, at one time we had what they were calling tourism fund, and we benefited. We applied for a loan from tourism fund, which helped us build Chapa, and then we got a loan from the bank, which facilitated in upgrading our business as well. But as a new entrepreneur, the basic factor is that one has to be disciplined. Make sure that whatever you receive as an income is banked. Don't run away from the bank which gave you the money. You go and deposit the money in another bank, so that there is that consistency. Because for me today, I can walk into my bank, which is Zambia National Commercial Bank, I can get a loan at any time. Because we have paid back our loans on time, or actually before time, we set our loans. So we've got a very, very credible name with the banks. Empower the Zambians with the money available so that we can upgrade our places to market them widely and compete favorably with other competitors.
And that's it for this edition of Global Business on the day when the South African Rand rose to a 2-month high. Quite an interesting emerging markets rally coming through. Do remember, however, you can send your feedback to the program on Global Business Africa at cctv.com and wherever you are online. We're there too. Stay in touch over there on Twitter and on Facebook. Thank you for watching. I'm Ramanya.